Okay, you guys, so the battle over GameStop stock has gotten so many new people interested in investing, which I am super excited about because I'm a total financial nerd. But I'm also really worried that a lot of these people are going to fall victim to the predatory financial tactics that so many people out there are pushing right now. I mean, you do one scroll through TikTok and you're going to see so much bad investing advice, people giving you get rich quick schemes or telling you how they made over 1,000% return on a risk-free investment. And I mean, if it were that easy for us to get rich, don't you think we would all be doing it? So to help you weed through the BS financial advice that's out there and become a successful investor, I'm going to tell you how you can invest the smart way. And it's not going to get you rich quick, sorry about that. And if that makes you want to skip this video, I have a question for you. Do you want to gamble with your money and maybe get rich, or do you want to get rich for sure? If you answered option 2, I'm going to tell you a way that's almost guaranteed to make you money in the stock market and give you my 3 tips to maximize your returns. Tip number 1 is a popular phrase that you may have heard in the personal finance world, and it is time in the market beats timing the market. And this basically means that the longer you leave your money invested, the more money you'll make. And that's all thanks to compound interest, or what Warren Buffett calls the 8th wonder of the world. He's probably so fond of it because Warren Buffett made over 99% of his wealth after the age of 54. Yeah, that's right. If Warren Buffett had cashed out his investment portfolio and retired at 60, he wouldn't have become mega rich, and you might not even know his name today. He was able to amass so much wealth because he left his money invested for such a long time and let compound interest work its magic. Compound interest is so great because you earn interest on the interest that you already earned. This allows you to create exponential growth in your portfolio, but it takes a while to see really huge gains. That's where time in the market comes into play. The longer you leave your money invested in the stock market, the more money you'll make from compounding. Take a look at this graph of Berkshire Hathaway's earnings over 53 years under Warren Buffett. You can see in the beginning that the growth is slow and steady, but toward the end it spikes almost straight up. Much of that is thanks to compounding and the exponential growth that it's generated over time. Timing on the market is super fast-paced and involves someone trying to buy a stock at its lowest price and then sell it at its highest price. This sounds simple enough, but if it were that easy, then the hedge funds would have seen their billion-dollar GameStop losses coming, and they didn't. The problem with timing the market is that it's a short-term investing strategy, and it's nearly impossible to predict what's going to happen in the stock market in the short term. I mean, if everyone knew that the stock market was going to crash and housing prices were going to plummet in 2008, they would have avoided it and no one would have lost money. If everyone saw the huge stock market drop coming in March of 2020 when the novel coronavirus hit, I mean, we all would have avoided losses with that too. And the same is also true of the GameStop stock price surge. If the hedge funds had seen that coming, they would have avoided those losses. If it were as easy as it seems to predict these swings, we would all be doing it and making a lot of money. But it's not easy to do it. It's nearly impossible. And that's why time in the market usually beats timing the market. To get as much time in the market as you can, it's important to start investing as early as possible. Before you start investing though, you need to have an emergency fund. That's because if you lose your job and your stock portfolio tanks, you're gonna need some money to live off of. That's when your emergency fund comes in handy. So first, build up an emergency fund, then start investing. Tip number 2 is to choose a reliable investing approach. So once you have your emergency fund saved and are ready to start investing, you have 3 basic investing approaches that you can choose from: trading, value investing, or long-term passive investing. Each strategy has a different level of risk associated with it and a different level of effort required if you want to succeed at it. So you're going to need to assess what risk level you're comfortable with and how much effort you want to put into managing your portfolio. To find out your investing risk tolerance, I've linked a quiz in the description box below. But to figure out the amount of effort that you're willing to put into managing your portfolio, I'm going to tell you a little bit more about each of these 3 investing strategies. The first one is trading. So trading is an active investing strategy that relies 100% on timing the market. The goal with trading is to buy a stock at a low price and then wait until it increases in price to a certain amount and then sell it at a profit. Some traders only hold a stock for minutes or hours before they end up selling it. So it's super fast-paced and requires a ton of research. Like I mentioned earlier, it is nearly impossible to predict what a stock's price is going to do in the short term, so there is a lot of risk and a high potential to lose money with this strategy. If you want to succeed at it, you're going to need to put in a lot of work and do a lot of research. That means researching individual stocks, market sectors, consumer habits, and so much more. Unless you thrive under super high stress and want to dedicate almost all of your time to managing your investment portfolio, I wouldn't advise trading. The second investing approach you can take is value investing, and this is a strategy that Warren Buffett uses. Value investing is when you buy stock in a company that you perceive to be undervalued and has an unforeseen growth potential. A stock is undervalued when the price that it's trading at in the stock market is less than the true value of the company. Basically, the stock is trading at a discount. It's just like when you buy something on sale at the store. You feel good about the purchase because you know you paid less for the item than it's actually worth. You're able to make money with this strategy because at some point the stock price should adjust to match the true value of the company. When the price rises to do that, you make money. It sounds simple enough, but there are still a lot of unknown variables that come into play when valuing a stock. To determine if a company's stock price is undervalued, you need to do a deep dive into their financial statements. And I don't just mean read them. I mean you need to take the information in them and use it to calculate things like their price to earnings ratio, price to book ratio, price to sales ratio, lots of other ratios, their EBITDA, tons of metrics, and to project their growth. Then you need to use all of these metrics that you calculated to determine if a company is undervalued and has a good growth potential. If it does, then this could be a good investment, but there are a lot of assumptions that are coming into play to make your decision. Those assumptions may be correct or they may not. To get great at value investing like Warren Buffett has, you have to make correct assumptions. Again, if becoming a billionaire were as easy as calculating out a few ratios, we would all be doing it. Finding ways to predict these unknown variables correctly is what Warren Buffett has gotten really good at and how he's made so much money. Unfortunately, these strategies are pretty hard to replicate. And the third strategy is passive investing. This is the strategy I use and the one I think works best for most people. Passive investing is a long-term investing strategy where instead of trying to beat the market, an investor seeks to receive the same return as the market. Passive investors buy index funds and ETFs that track an underlying set of investments and hold these for decades. Funds like these that track an underlying set of investments provide the same return as those investments. So for example, if you buy an index fund that tracks the S&P 500, your fund will perform the same way that the S&P 500 is. No better and no worse. The reason passive investors are okay making the same return as the market is because historically the market has always gone up over time. Based on that, if you buy a well-diversified index fund or ETF that tracks the stock market, you can expect to make money over time even if the stock market drops in the short term. Because passive investing doesn't require you to predict market swings, this type of investing requires almost no effort. The only time you'll need to exert any effort is when you're choosing what funds you want to invest in and when you're rebalancing your portfolio. While there's never 100% certainty when it comes to investing in the stock market, since historically the stock market has always gone up over time, the probability that you'll be able to make money using this investing strategy is much more reliable than the other two investing strategies we've discussed. Tip number 3 is don't lose money to taxes and fees. Both of these things can eat into your returns very quickly and quite substantially, so here's how you should avoid them. When you sell a stock, you have to report your earnings as income and then you're taxed on those earnings. But the amount that you're taxed depends on the amount of time that you held that investment for. So if you buy and sell an investment within a year, you're going to be taxed at the short-term capital gains tax rate, which is the same rate as your normal income tax rate. This is typically around 20 to 30% for most people. Side note, all of the Reddit investors might not know this yet, but they're all going to have to pay 20 to 30% in taxes on all the money they just made. So if that was you, put some of that aside. Instead, if you hold your investments for over a year, you'll be taxed at the long-term capital gains tax rate, which is typically around 15%. That means that just for holding your investments for a little bit longer, you can get 5 to 15% more money in your pocket. And this is another reason why many investors choose a long-term investing strategy over a short-term one. When it comes to fees, traders and investors are going to need to look for different things. So if you do still want to trade stocks, then I would suggest making sure that you're going to do so on a platform that offers low to no transaction fees. And that's because when you're trading, you're buying and selling a lot. So every time you make one of those transactions, you'll be charged a transaction fee. And that can eat a lot into your returnings. There are plenty of platforms out there that offer no to low investing fees. So I would make sure you set up an account with one of those if you're planning on trading stocks frequently. Long-term investors, on the other hand, need to watch out for expense ratios. And so many people get tricked into investing into funds that have high expense ratios, because funds with high expense ratios don't really seem like they have high expense ratios. And that's because by like normal standards, these percentages are really low. So for example, a fund with a 2% expense ratio actually has a really high expense ratio. But like most people, when they see 2%, think, oh, that's not that much. So when deciding what fund to invest in as a long-term investor, I would look for a fund that has a 0.5% expense ratio or lower. And this may seem trivial, like 1.5%, but let's talk some numbers. If a person invests $1,000 into a fund with a 0.25% expense ratio for 30 years and receives a 7% return, they'll end up paying $55,000 in fees. And I mean, I know that already seems like a lot, but wait until you hear what the 2% fund investor will pay. So if instead this person had invested their money into a fund that had a 2% expense ratio, they would end up paying almost $376,000 in fees. That's over 6 times what the low expense ratio investor paid. And the low expense ratio investor ends up with $1.15 million in their pocket, and the 2% investor doesn't even end up with $1 million. So while these percentages seem like they don't really matter and they don't make a difference, they make an enormous difference. So make sure to check your expense ratios and always invest in funds with low ones. When it comes to newbie investors, there is no shortage of misinformation out there, and social media platforms are making this misinformation spread like wildfire. And I get it. I mean, smart investing is not glamorous or quick. It means that you have to invest for the long haul and try to do boring things like minimize your taxes and fees. But while it's definitely not glamorous and there's no guarantee that you will ever make money investing in the stock market, I can almost guarantee that if you focus on these two things, you will. Thanks so much for tuning in with me, you guys. If this helped any of you newbie investors figure out your investing strategy and feel confident about investing, please make sure to give this video a thumbs up, because I want to be a rich bitch just as much as you, and it helps me with the algorithm. If you are interested in personal finance, investing, and building your wealth, I release a new video every Saturday that covers these topics, so make sure to subscribe to my channel, and I will see you soon. Bye!